Hello students, in the previous video we covered the first 7 points till the flotation cost. Now we would move ahead with the tax rate. For explaining this point, I have taken the help of one example so that it is clearer to you. Tax rate means interest on debt is a tax deductible expense. So higher the tax rate, relatively that source of debt is cheaper. So more debt can be used. For example, borrowing at 10% and the tax rate is 30%. So after tax cost of debt is only 7%. Let us understand it. Say here we are given 10% debentures in place of bank loan. Here we have taken debentures in our example. We are say raising our fund through debenture at the rate of 10% and tax payable on our income is 30%. So in the first case, our earning before interest and tax is given as 40,000. From that, as you know, we have to deduct I, that is interest first. So 10% of 1 lakh debenture is rupees 10,000. So earning before tax would be 30,000. Now this is our earning on which we will be paying tax at the rate of 30%. So taxation at the rate of 30% of 30,000 comes to 9,000. Now assume that there is no debt in the firm. So instead of 10,000 we will have 0. So 40,000 minus 0 equals 40,000. On that 40,000 we will be paying tax again at the rate of 30%. So that is 12,000. Now compare these two figures, 9,000 and 12,000. So if we have debentures or debt in our structure, we have to pay only 9,000. While if we have only equity in our structure, we are paying 12,000 as tax. So tax saving due to debt is 3,000. That is 12,000 minus 9,000. So you can say the net interest payable is actually interest payable minus tax savings. So 10,000 minus 3,000 equals 7,000. So we can say that on debentures we are not paying 10,000 but we are actually paying 7,000 only, because 3,000 is our savings because we have debentures or any kind of debt at the rate of 10% in our capital structure. So availability of debt or using the debt finance in our capital structure would make our overall cost of capital lower. So this is about tax rate. So higher the tax rate, lower is the cost of capital, because interest of debt is tax deductible. Right? Now we will go to the next point, that is control. Now issue of debt normally does not cause a dilution of management control. Right? Because they are not the owners of the business, they are investors of the business. Whereas issue of more equity may reduce management's holding in the company. And there is a threat of takeover also, because if you have lesser of promoters hold and more of public hold through equity shares, then you may get bids, bid of buying your business from third parties. So this factor of control influences the choice between debt and equity, especially in the company in which the current holding of management is on the lower side, or you can say promoters holding is on the lower side. How would it become on a lower side? Because you kept on issuing equity shares in the market. So gradually the ownership got diluted in terms of number of more and more equity shareholders. So more equity shareholders means more dilution of control. So if the management or the promoters wish to have good control over their business, they may not like to issue equity shares. Rather they would go for debt financing, because debt providers are the investors and they do not have any stake in the voting rights or over the control of the affairs of the firm. The next point is flexibility. If a company uses its debt potential to the full, it loses its flexibility to issue further debt, right? Because More debt means more interest payment. Right now, if you are already paying a lot of fixed financial expenses, you are losing your flexibility to borrow further. So, to maintain flexibility, it must maintain some borrowing power for unforeseen circumstances also. It's like you do not spend your whole income, you save something for the future as well. In the same way, you should reserve your borrowing capacity for some unforeseen events in the future. You should not use your full capacity of borrowing currently, right? You should borrow, but within or in a certain limit, so that you have some room, some flexibility to borrow more in future. It's like you are saving for your future, you are saving your borrowing capacity for your future expenses or your future growth modernization plans. If you are utilizing all your earning right now for having the or for repaying the debt obligations, you won't have any room in future to borrow further. Right? It's like you have taken from banks, loan from banks, you have taken loans from other financial institutions, you have issued debentures also, you have issued preference shares also. So now in future, if you want to issue such debt instruments, you won't have any scope with you, because already you have utilized all the debt sources. So if you want to have some flexibility in future, you should not be using all your debt instruments in the present. The next point I will be explaining in the next video. Right now I will be sending some homework assignments related to these points. I do not want to overburden you with all the points. I want to give it in installments. So I advise you to go through these points from our notes and from our textbook or any reference book you have. And if you have any doubt, let me know. If all these points are clear, then only I will move ahead with the next points. Thank you and have a nice day.